I wanted to talk with you today about what we're doing with the closing process as we get our accounts ready to prepare financial statements. Now, the first step in getting our accounts ready to prepare financial statements is adjusting them. And it was that adjusting process we talked about in Chapter 3, where we take care of those accruals and deferrals and get those accounts ready to go. Once we've done that, we have to close accounts. And we do that by zeroing out revenue and expense accounts because they need to be empty to start next year. So we need to close those. Now, the process to do that is really simple. Revenue accounts, as we can see here, have a normal credit balance. So to close them out, we need to debit them. So they have a zero balance. But every debit has to have a credit, and that debit to revenue gets a corresponding credit to income summary. Now, we have to do the same thing with expenses. However, expenses, they have normal debit balances. We've got two expense accounts here that we're going to close, rent expense and salary expense. So we're going to credit each one of those accounts to zero them out, and they'll get debits to income summary as well. Now, in normal situations, what we hope for is net income. Net income means that revenues are greater than expenses. If that's the case, then income summary will have a normal credit balance. Credit balance in income summary tells us that we have net income. A debit balance in income summary, where expenses in total were greater than revenues, would tell us that we have a net loss. So here in this example, we've got income summary, we've got net income, and we need to close out income summary because income summary is a temporary account. It's a placeholder. It has a zero balance except for that little bit of time we use it during the closing process. So income summary here is going to get a debit balance to close it out. Now it has a zero balance. And that debit has a credit to the capital account. Because what we're doing here is moving income from the income statement accounts to the balance sheet, to the equity section, because net income belongs to those owners. So we're zeroing out the income statement accounts, getting them ready for next year, and updating those balance sheet accounts in the equity section to where we need to be today. Now, there's one more closing process journal entry. Any withdrawals during the year, any payments we made to owners, we need to close this drawing account out as well, which we do with a credit since it had a debit balance. And that goes to the capital account as well because withdrawals to owners reduce capital.